This is In the Final Analysis. I'm Jim Yockey.
Welcome to the In the Final Analysis podcast. Here is your host, Jim Yockey, Managing Director of Wisdom Financial, and I am the Media Support Manager, Kylie. This day on In the Final Analysis, we're going to be talking about headline uncertainty. Because we talk about uncertainty a lot here on the podcast and how it relates to your financial journey and your money emotions and all of that good stuff with behavioral finance. But every day, new sensationalist headlines like hit the eyes and the brains and the anxieties of the American and global public, whether it's fresh tariff changes from the U.S. executive administration or stock market volatility, and what else? Everything else. So, Jim, could you speak to what might be some mindset tactics that people can use to help combat panic reactions about their money after seeing these headlines every day?
Yeah. After 44 years in this business, I probably have seen it all until now. because because there are it goes beyond what my investments are doing on a daily basis, and it's encompassed in a whole lot of other things, whether it's governments, uh, global issues. We're in a real state of flux, probably globally. So when we are listening to the news or watching the news, or if somebody reads papers anymore, maybe we're doing that too, or listening to the radio, there are a couple of things that come to mind first. First of all, the news media always reports on things that create interest. Typically, that interest has something to do with something that's going wrong. Okay, so that's the first thing that we need to consider. Consider the source. Consider the reason that they're reporting on that, and always you come back to the fact that they have a self-motivation in order to report something that will increase their viewing and increase their revenues. So all news medias are driven by the same thing, advertising. So that's the first thing. Remember that you're going to be fed a lot of stuff that may or may not either happen or did not happen in quite the way that it's being reported. So there are a lot of things that you can think about first before you do anything else. Interestingly enough, when you're talking about money and the disruption, emotional disruption that you feel sometimes, because the headlines, the stock market dropped 419,000% today, and so now I'm worried. Okay, so you got to fundamentally we're trying to accomplish certain objectives or goals with our money, but the truth of the matter is, all of us have the same regard for what we want to do with our money and our future. We want to make more money and not lose any money. So that's the first thing. Is if I'm looking at the headlines, I have to decide whether I'm reacting emotionally, or am I being analytical about it. And my advice to you right out of the box is set your emotions aside, and you can do that very easily by saying, is there anything in these headlines that I'm seeing that's going to affect me today? Or am I being endangered today on this? Okay. So you can clarify how you're looking at the uncertainty that's created by those headlines, right? So you do that by moving away from the emotional part of it and saying, am I being Is there a bear coming at me? Am I going to be safe today? Okay, so that helps you step away from the emotional reaction of trying to forecast what's going to happen to you as an individual by what you're reading or seeing in the headlines. That's the first thing. Try to move away from pinch yourself, whatever. You need to move away from reacting emotionally and forecasting the future right on that spot based upon whatever that headline is, no matter how fearful it is. Okay. And in our lifetimes, there are all going to be big headlines that you feel like it's going to affect you today. Oh my gosh, what's going to happen? But you stop and think about that and start looking at it analytically. Okay, so you have to take the consideration analytically and say, if I don't have to worry about this for today, then how can I calculate, or how can I view what this is going to have to do with me anyway? Is it going to, I'm not invested in any of those things. I'm not in the same position, so I'm just going to dispense with it. Or, because you're looking at it analytically and not emotionally, then you can make a point of saying, well, I'm going to put a number on this, a number of 1 to 10. If I think it's really going to affect me personally, it's a 10. If I think that it's not, it's a 1. Use 1, 5, 1, 10, whatever. And you can actually rank it on how much consideration you need to make for that headline. So that helps you stay analytical about it and unemotional. We get tied up in this. And the real kicker is you don't want to react to something based on the news. You really don't. You want to react to something that's in the news as it affects you directly or your family. And so we need to move into an analytical thing every time you're looking at the news media, knowing why they're reporting on that, because of what. It's like weather. We see weather. You check the weather 19 times a day. Is it going to rain today? What's tomorrow going to look like? But we're looking at that analytically. And if we find that there is something that's going to affect us, then we can make a plan, either to address it straight, avoid it, whatever. And interesting, the weather does this for you automatically, because they give you the probability of what the rain call is going to be, or the weather event is going to be. Well, we have a 60% chance of rain today. Okay. Well, so they're already helping you be analytical about it. So use the weather person's view of headlines before you jump in there and think it's life threatening for you. Okay.
I love that.
That helps.
But yeah, and I'm sure that it's also worth mentioning, we are calling this headline uncertainty, and we're talking about reacting to headlines. But part of that analytical viewpoint that people should take on is making sure that you're reading past or listening past the headline. Does the actual content of the news broadcast, whether it's, written or on TV or whatever, do the details actually affect you?
Correct. Absolutely. If you have an investment in a stock or a mutual fund or something like that, and you're looking at that for an objective for down the road, I want to make more money and not lose any money. Well, obviously you're going to be concerned. Is this really going to affect me? Okay. Now, this brings up a topic that's sincerely something that we as individuals need to consider. In the educational system, we really don't introduce managing money or financial courses unless you're specializing in college. Now I understand that there are some high schools are now requiring a course in financial management before they can graduate, which is a wonderful idea. But we don't get a lot of training across the educational landscape unless finance is what your major is, right? So often we take the opinion that, well, we're going to let somebody else make those decisions. We need, if we need the information, we need to go make an investment. We'll ask somebody at some point. Now, the world's changed. You have a couple of different ways of making those kinds of decisions. Number one, you can pick any brokerage firm that will accept your account, and you can put money in there and make your own decisions, which requires you're going to have to make more decisions and have more research and spend more time doing that for yourself, which is great. There's nothing wrong with that. Recognizing that if you are going to invest money in any of the markets, like the bond market or the stock market, you are going to deal with a financial professional of some kind. Okay. They either give you advice or don't give you advice, depending on what kind of an account you've set up. And they don't pretty much care what the results are either, because that's up to you, So you have to pay attention to that. If you want help, you could probably call them and ask them questions and stuff like that, but they're not going to get that close up and personal view of what the decisions you're making and what the impact it is on you. To get that, you generally can go to a financial advisor who is licensed through the SEC and FINRA and registered investment advisor, one of those kinds of people. And those people have a fiduciary responsibility to advise you correctly. Okay. The thing that I have stayed concerned about when it comes to advisors is there are a lot of levels of difference for advisors to be committed to having a personal relationship with clients. Some of them want to get, like we do around here, we want to know everything that happens in everybody's life, because then we can help them all through the stages of life. And so we become a part of the fabric of the family. But there are a lot of financial advisors who don't do that. Okay. That's up to you. That's up to you to decide how intimate you want to get in that relationship with a financial advisor. But both of them require your participation, active participation in understanding exactly what you're investing in and why. And those are important features of having a financial advisor, or even doing it yourself. You have to know that you're making a decision for a certain purpose, and you understand what the upside and the downside effects can be on that. But the final comment that I can make about your question is, it's up to you personally to participate intellectually as well as monetarily. And it's only you that ultimately is going to be affected by what you're investing in and why. So you really need to be knowledgeable about what it is. And if you're with an advisor that doesn't take you down that path, you need to find another advisor. Okay.
Right. No, yes. Thank you for emphasizing that. That's so important. And especially like during times of economic and investment volatility, like we're seeing lately, what are some of the conversations that a financial advisor might be having with their clients about some ways to participate in financial growth strategies like that while staying protected both intellectually and monetarily?
Ooh, that's a very complicated question. Let's see. When you make a decision of investing, it's going to be in several different genres. For example, it will be bonds, It'll be mutual funds. It'll be exchange traded funds. It will be mutual funds of any kind. It will be through an advisor for individual stocks or whatever. So and it's really gotten very complex. And before I launch into fully answering your question, we all need to understand that we're in an institutionally driven marketplace, which means the institutions manage trillions of dollars. Now, this could be just a college, university's pension plan, or somebody else's pension plan, or a big corporation that has a pension plan, 401ks. 401ks, we're actually committed to making our own decisions, even in a 401k. So that's going to push you into the institutional management anyway. So when you look at that, you have to look at it as that you have your precious money at risk there. And if you're getting advice to help you make decisions within the scope of institutionally driven management, that's helpful. The institutional managers are not passionate about anything except for the returns for their portfolios, because that's how they report, right? And so they're not personal with you. So your own outcomes are not on their big radar. It's the report of the total portfolio that they manage institutionally. So they are not completely, but almost completely void of any emotional impact on their strategies. It's up to us, however, to be able to know that we're using the right institutional manager, and that means what you're directing them, how aggressively you're directing them to manage your money or your participation. And so you have decisions that can influence which institutional managers you're using, but it is ultimately the institution that's going to be doing everything. So if that indeed is the truth, the responsibility can easily by you just fall over and say they're going to make the right decision for me anytime. Wrong. Because it's your money and it's precious to you, but it's an aggregation on their part. So does that kind of get to the first part of all this, is realize what the water is going to look like?
Right.
Is it, how deep is this water going to be? Okay, and do I know how to swim? So there's now the second thing is time. In our industry, we have used time as a reckoning point, really, for flows of money and returns. The longer you stay invested, the possibility for you is to have a better outcome. Okay, that's quite unlike if you go to a casino. The longer that you stay there, the more money the casino is going to win from you. Okay,
right.
So this is not what you want to reverse. you don't want to be at that table too long.
Right.
So as opposed to then making rational decisions about your investment that may be for the long time. And so you go through a life cycle of choosing, how much time do I have to make this investment work for me? That's a very primary question that you need to ask every time you're placing money on the table. Okay? The older that you are, our industry typically has said, well, as you approach, and some of the 401k plans, for example, have these target funds which say, okay, my retirement's going to be in 2062. Okay, so they're going to invest your money based upon that deadline, right? Which means you're likely to be in more growth oriented stuff early, and they'll systematically move you off to more safe stuff and income based stuff like bonds. All the way, the closer that you get to that retirement target, you're likely to be more in things that provide income. Well, that's one standard thing that sometimes doesn't work out as well as you think. Okay, because you could actually be in bonds at a time that you really don't need to be in bonds. If interest rates are really high, it's pretty good. But you have to understand that if interest rates start to fall, it could be even better. Or as you're getting into it, and you're buying high, it could be more painful for you. So your decisions still have a play in that. So interestingly enough, many times when you get older, when you're young, you think you have the world and you can invest and it's all going to work out just fine. And, I have a long time. So if I make a mistake, I can make up for it. Well, that's one way to look at it, but not a prudent way. Okay. You need to look at it rationally and say, look, have I made a mistake, and reevaluate how you're invested. As you get older, too, what I have really noticed is that people don't necessarily want to have all of their money and stuff that is delivering some kind of return by sending us cash. Okay, a liquid or a bond, for example, is paying interest. Many people, when they get older, they realize that they got to retirement, for example, thinking that their tax burden was going to go down, and actually it doesn't. So, and a lot of the money that you're going to take as income will come out of your retirement assets, and that's going to be taxed too. So your tax bracket is not going to necessarily go down.
Right.
Number two, many older people have they've considered that and said, I don't want to take money out of my IRA or whatever, because I have to pay tax on it. So they are still involved in having a portfolio that has growth. It's just that the older that you get, you recognize that you have a shorter time frame if you have a mistake to adjust for that mistake. But the truth of the matter is, if you're investing once you get older, sometimes you're investing it not only for yourself, but for your heirs, your children, your grandchildren, and all that stuff too. So being growth invested, even in the latter parts of your life, is still something that's desirable because it meets what your longer term goals are.
Gotcha.
So take into consideration this idea of time as being both friendly and your enemy. Okay. So every time you make a decision, or your financial advisor is making a decision to help make a decision with you, ask what's my time frame on this? If something goes, do I have liquidity? Do I have downside protection? Do I have upside? Anything? What's my expectation for upside? Downside, by the way, downside protection has become a whole lot easier for professionals to help you determine whether or not you have downside protection of any kind. It's becoming much more available, but nonetheless, it also takes into consideration the time frame. How long am I going to leave this money in this particular investment? So, did I get around to answering all of that?
Yes, thank you so much. Yeah, those are some really great considerations. Whether, you're participating in financial growth strategies by yourself or with an advisor, of making sure that you're thinking, fully 360 about those things.
Oh, very important. Yes.
And so I know that next time that we're going to be talking a little bit more about some of the biases you might be bringing to those questions and considerations. Um, spoiler alert, we're going to touch onto the sunk cost fallacy, which I believe we've mentioned before in a previous podcast. So get ready for that again, as well as loss aversion bias, which I think a lot of people might be dealing with, especially right now in our volatile economic state.
Yeah, the interesting thing about that is we're not only sunk cost, which is we get caught by that all the time, but we also have something we're going to talk about this a lot, loss aversion. We're going
Mhm.
to talk about that really. It's going to hit you right between the eyes.
I know, I can't wait to get into it. But that will be for next time. And in the meantime, listeners, you can find more resources to help you think about your money mindset and some of your decision making processes for planning, including we have a new Time for Tariff Truths white paper, which is updated through about mid-April 2025, kind of touching on everything that is going on right now in our headlines, as well as our bias pulse checks. But again, we'll get into that more in the next episode. You can find all of our resources at www.wisdomchoice.net, our website, where you can also sign up for our newsletter so that you're the first to know when new In the Final Analysis episodes come out. And also, you can use our website to let us know if you want any help or answers to questions about weathering current times. Our primary goal, both on our website and our podcast, is to educate. But we're always here for you if you do want to reach out as well. And
And in
so,
the final analysis, you
yeah.
are really, really going to enjoy the monthly video that we put in today. As a matter of fact,
Oh, yeah.
it's
Today was a good one.
yeah.
Yeah. So you can get those. Our newsletter sends out about once a week. So if you're interested in past newsletters that you worry that you're missing out on educational information, just let us know and we can totally send it your way. And like I said, all of that can be found at www.wisdomchoice.net. And thank you all for listening. And thank you, Jim. All right, bye.
Thanks for tuning in to the final analysis. We try to keep you informed. Be sure that you're on the email list and call us if you have any questions whatsoever. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professionals before making important investment decisions. Securities offered through Cambridge Investment Research, Inc., a registered broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Wisdom Financial Management, LLC are not affiliated.